Hello everyone, welcome back to my channel. If you're new here, hello, my name is Fernanda, and on this channel we talk about personal finance, personal development, and I help you make a mindset shift to get you to your financial goals even faster. By now you probably know that I am a huge believer in financial literacy. I also believe that it's important to have an understanding of how the overall economy works. So if you've ever wondered exactly how the UK government is planning on paying for this increased spending, just keep on watching. Before we get into it, are you subscribed to this channel yet? YouTube tells me that about 90% of the people who watches these videos aren't subscribed to this channel yet. So it would really help me out a lot if you just tap that little red subscribe button down there until it turns blue and make sure you never miss a video. Now, I know a lot of people worry about how exactly the UK government is planning on paying for these unprecedented times. We all know that there's no such thing as a free lunch on this planet, so even though things like the furlough scheme and the Eat Out to Help Out push have had their role to play in helping out the economy throughout the event, it's important to remember that there's no such thing as government money. This money comes from taxes that both you and I pay, so it's not just the government's money to give away. So how exactly Boris and Rishi are planning on paying for all these schemes has been a question on a lot of people's minds. Initially, everyone just figured we would see a spike in taxes. There's actually talk of now taxing people who are working from home to make up for the decreased footfall in city centres and to help protect jobs that rely on that. Now, normally, when a government needs to stimulate a country's economy, their first port of call is to decrease interest rates. If you've ever wondered what on earth that actually means, it basically affects all sorts of different things, but the way that it applies to both me and you, mere mortals, is that it basically makes credit a lot cheaper. The basic interest rate is set by the Bank of England, and it basically dictates how much the financial sector, so that's mainly banks, can charge for credit. That's why whenever a new interest rate cut is announced, you'll see people rushing to get a mortgage or to remortgage their home if that's an option available to them, because they know they'll pay less in interest. It also makes it cheaper for businesses to borrow money, which increases their investment and again stimulates the economy and helps things keep ticking along nicely. The problem we're now facing is that the basic interest rate is already so low, there's no room to reduce it even further. So, in an effort to further stimulate the economy, the government has resorted to something that a lot of people call printing money, but it's really not that simple. Before we get into the nitty-gritty, it is important to understand the difference between the government and the Bank of England. The government owns the Bank of England, but they are still separate entities. The Bank of England has specific legal responsibility for setting policies, for example, for setting interest rates, to help with financial stability, and for the regulation of financial services such as banks and insurance companies. This would be really hard to do well if the Bank of England was under political influence from the powers that be. And that's why the Bank of England operates independently from the government itself. Now that we have that out of the way, you might have heard or read the term quantitative easing recently, and this is economy stimulation trick number 2 up the government's sleeve. You know how at any one point there's a certain amount of money circulating in the economy, right? Well, this is called the monetary base. It's the basic amount of money that there is in an economy at any one time. What happens when the Bank of England starts implementing quantitative easing is that they go over on their little computer, push that number up, thus increasing the monetary base. The Bank of England then uses that money to buy government bonds, which is basically like them lending the government money, and then the government in its turn promises to pay that money back with a little bit of interest on top. So whenever the demand for these government bonds goes up, their prices also go up. And when the prices of government bonds go up, the interest rate on credit lending goes down, which again makes it cheaper for people to borrow and spend money, thus stimulating the economy further. Now, it might be right about now that alarm bells are going to start ringing in your head and you'll think to yourself,
I've always heard that more money circulating in the economy means inflation. Why isn't anyone freaking out about this?
The reason why this is not the case with quantitative easing is because this new money is not actually being printed out and put into people's bank accounts, for instance. So it's not technically new money that's circulating in our everyday economy, and thus the prices of everyday goods don't go up. But like I mentioned in the beginning of the video, there is no free lunch on this earth. So whilst this printing money spree is helping the government pay for all of the help it's given businesses and people throughout this period, and it hopefully means no tax rises for us on the horizon, it does affect your wallet in different ways. First of all, the Bank of England itself found after the first time it implemented quantitative easing back in 2012 to help with the effects of the Great Recession of 2008, that this kind of stimulus increases share prices. So while it's good for anyone who already owns those shares, it makes it harder for people to start investing in public companies. Second of all, it also found that it increases property prices. So whilst that's great for anyone who already owns a property, it makes getting on the property ladder that little bit harder. House prices have already increased by about 5% in 2020 alone, so gird your loins, guys. And finally, higher bond prices greatly affect the cost of pension schemes. So it's definitely time to start thinking about your retirement savings. I have a video on saving for retirement, which I'll link up here for you. And hopefully it will help you get started if you've never given your pension pot a second thought up till now. My one little piece of advice for you is to, as always, in any circumstance, just make sure that you are managing your money the best that you can. And really, don't worry about it too much, because recessions come and go, the world keeps turning, we all keep ticking along, and it will be the same with this case. That's it for today's video, guys. Thank you so much if you've made it this far. I know I'm a little bit of a nerd who enjoys talking about these things, but hopefully if you made it this far, you've learned something new today. If you did find this video useful, please make sure to give it a thumbs up. And if you'd like to see more videos from me, make sure you do subscribe to this channel. I would really love your help in growing this channel so that we can get this message of financial freedom to as many people as possible. Also, if you'd like to get up to 3 free shares worth up to £200, make sure to check the links in the description and I'll have those free share promotions linked out there for you. Thank you so much for watching and I'll see you on my next video. Bye!